Hello, my dear friend. I'm happy to welcome you to my channel. If you're here for the first time, don't forget to subscribe so you won't miss more helpful videos about health and everyday life. Give this video a big thumbs up, it really motivates me to keep creating simple and valuable content for you. Now let's get started, it's going to be interesting and useful. Credit is money that a bank or other financial institution lends to an entrepreneur or company on the condition that it will be repaid later with interest. The core idea is simple, you get funds now and give them back over time, while the lender charges interest to earn a return and cover its risk. Used wisely, credit lets a business grow even when its own capital is limited. Main types of business credit. Working capital loans, short-term borrowing to cover day-to-day needs such as inventory, payroll, or temporary cash flow gaps. Investment loans, longer-term financing for major projects, new equipment, facility expansion, or entering a new market. Credit lines and overdrafts, revolving limits you can draw down as needed, you pay interest only on the amount actually used. Leasing, a specialized loan for equipment, you gain immediate use of the asset and pay for it in installments instead of buying outright. Factoring, selling your accounts receivable to a finance company and receiving most of the invoice value up front, while the factor later collects from your customers. Every loan comes with 5 key parameters: principal amount, term, interest rate, repayment schedule, and security, collateral or guarantees. The interest rate is the lender's price for risk and the time value of money. The longer the term, the lower each installment may be, but overall interest cost usually rises because you pay for a longer period. How lenders decide. Banks assess creditworthiness before approving a loan, focusing on cash flow strength, will future profits and cash inflows comfortably cover repayments? Borrower reputation, management experience and past credit behavior. Collateral or guarantees, assets the lender can claim if the loan is not repaid. Industry and market risk, how stable is the sector, and what external shocks could hit the business. A loan is approved only if expected business gains outweigh the lender's perceived risk. All terms are fixed in a legally binding agreement. Used prudently, credit is a powerful tool for business growth. Misused, it becomes a burden. In episode 2, we explore how to decide whether a loan is truly the right move and how to plan for safe borrowing. Before you borrow, ask the most important question: do we truly need a loan? Credit is justified when it funds growth, larger inventory that boosts sales, machinery that lifts productivity, or a marketing push that attracts new customers. Borrowing for routine expenses you could cover from cash flow, or for non-business consumption, often spells trouble. Step-by-step checklist. Define purpose and amount. Pinpoint the exact project and calculate the minimum sum required to achieve it, no more, no less. Test repayment capacity. Create a simple cash flow projection. Add loan installments and interest. Is the business still cash positive each month? If not, rethink. Compare offers. Gather quotes from several lenders. Look at the nominal rate, but also at fees, compulsory insurance, and early repayment penalties. Calculate the effective annual rate to see the true cost. Consider collateral. Assets pledged as security can lower your rate. If collateral is limited, a personal or corporate guarantor may help, but remember the legal obligations they take on. Check project profitability. Estimate whether the funded project will earn more than the total loan cost. A quick rule: expected return interest rate plus risk margin. Build a safety buffer. Hold a cash reserve or unused credit line for spikes in costs or dips in revenue. This buffer protects your repayment schedule when reality diverges from the plan. Finally, read the contract line by line. Key clauses to spot: variable versus fixed rates, grace periods, late payment charges, and the lender's right to revise terms. Clear planning turns debt into leverage rather than liability. Next, episode 3 shows how to manage the loan after the money lands in your account. Once the funds arrive, disciplined management is everything. The smartest loan can backfire if the money drifts into unfocused spending. Rules for effective loan management. Stick to the plan. Allocate every borrowed dollar exactly as budgeted: equipment, stock, marketing, not day-to-day overhead you can meet from operations. Create a payment calendar. Mark due dates and amounts in your financial dashboard. Automate transfers where possible to avoid human error. Maintain a repayment reserve. Set aside a slice of monthly profit in a separate account dedicated to debt service. Avoid late payments. Even a few days delay triggers fees and harms your credit record. If cash flow trouble looms, contact the lender early to discuss restructuring or a grace period. Consider early repayments. Extra cash. Crunch the numbers. If your contract allows penalty-free prepayment, paying down principal sooner shrinks total interest. Track project outcomes. Measure the revenue or efficiency gains produced by the loan-funded investment. If results lag, investigate and adjust quickly. Why credit history matters. Timely payments build a trustworthy track record that future lenders, investors, and suppliers respect. A solid history often unlocks better terms, lower rates, higher limits, or faster approvals. Conversely, defaults or repeated delays can freeze access to capital precisely when you need it most. Remember, a loan is not free money but a responsibility. Handle it with care and it becomes a springboard for growth. Neglect it and it may become an anchor. Mastering these fundamentals lets you leverage credit to accelerate your business journey, confidently, sustainably, and on your own terms.